After 4 decades in banking and finance, I've lived through every major inflationary period since the 1970s. I've seen how inflation can silently destroy wealth, eroding purchasing power so gradually that most people don't realize what's happening until it's too late. At JP Morgan Chase, managing over $3.7 trillion in client assets, we've developed what I consider the most comprehensive approach to inflation protection available today. Let me be direct. Inflation is not temporary, it's not transitory, and it's not going away anytime soon. The factors driving current inflation, massive government debt exceeding $33 trillion, demographic changes as baby boomers retire, supply chain reorganization away from China, and monetary policy constraints that prevent traditional inflation fighting are structural, not cyclical. They will persist for years, possibly decades. Most investors are completely unprepared for this reality. They're holding cash that loses 3% to 5% of purchasing power annually, which means $100,000 becomes worth only $86,000 in real purchasing power after just 3 years. They own bonds that get crushed when inflation rises. A 30-year Treasury bond loses approximately 20% of its value for every 1% increase in interest rates. They have stock portfolios concentrated in companies without pricing power that get margin compressed during inflationary periods. Consider what happened to retirees during the 1970s inflation. Someone who retired in 1970 with $100,000, a substantial sum at the time, watched that money lose over 60% of its purchasing power by 1980. They couldn't afford the same lifestyle, couldn't maintain their standard of living, and many were forced back into the workforce. At JP Morgan, we've analyzed every inflationary period in modern history: the 1940s wartime inflation that saw prices double, the 1970s stagflation that combined high inflation with economic stagnation, the emerging market hyperinflations of the 1980s and 1990s, and current conditions. What we've learned is that beating inflation requires a systematic 3-step approach that most individual investors have never been taught. The families and institutions that not only survived but thrived during these periods followed specific strategies that protected and grew their purchasing power while others saw their wealth evaporate. These aren't complex financial engineering tricks. They're time-tested principles that work in any inflationary environment. Today, I want to share exactly what we tell our wealthiest clients about inflation protection. This is the same 3-step plan that preserves and grows wealth for billionaire families, sovereign wealth funds, and institutional investors who can't afford to get this wrong. Before diving into the 3-step plan, let me explain why traditional inflation protection strategies don't work anymore and why you need a completely different approach. Most people think they can beat inflation by buying Treasury inflation-protected securities, but TIPS only protect against official inflation as measured by the Consumer Price Index, which significantly understates real inflation experienced by most families. The CPI uses methodologies like substitution effects and hedonic adjustments that minimize reported inflation. While the government reports 3% inflation, families experience 6% to 8% increases in housing, food, energy, and healthcare costs. Others believe stocks automatically protect against inflation because companies can raise prices. This is only true for companies with strong pricing power and low capital intensity. Many stocks actually perform poorly during inflationary periods because rising costs squeeze margins faster than companies can raise prices. Companies with high debt loads suffer when interest rates rise with inflation. Technology companies with no current profits get crushed when investors demand higher returns to compensate for inflation. Real estate is another popular inflation hedge, but it comes with concentration risk, illiquidity, and management complexity. Direct real estate ownership requires significant capital, limits diversification, and involves maintenance, tenant management, and local market risks. Real estate also doesn't always keep pace with inflation. Many markets saw real prices decline during the 1970s inflation despite rising nominal prices. Gold has historically been an inflation hedge, but it produces no income and can be highly volatile. Gold lost 50% of its value in real terms during the 1980s and 1990s despite continued inflation concerns. It's useful as portfolio insurance, but insufficient as a complete inflation strategy. The problem with traditional approaches is that they're single asset solutions to a multifaceted problem. Inflation affects different parts of the economy at different times and in different ways. Energy inflation hits transportation and manufacturing. Food inflation affects consumer spending. Housing inflation impacts real estate markets differently than financial assets. Protecting against inflation requires a comprehensive strategy that works across multiple scenarios and time horizons. At JP Morgan, our three-step plan addresses every aspect of inflation protection through a systematic approach tested across multiple inflationary environments and refined through decades of managing money during both inflationary and deflationary periods. Step 1, build a real asset foundation. The first step in beating inflation forever is establishing a foundation of real assets, investments that maintain or increase their value as prices rise throughout the economy. This isn't about buying any real asset. It's about building a carefully constructed portfolio that has demonstrated inflation-beating performance across multiple economic cycles. At JP Morgan, we define real assets as investments that derive value from physical or tangible assets rather than financial claims. These include equities in companies that own physical assets, commodity-related investments, real estate investment trusts, infrastructure investments, and natural resource companies. The key insight is that not all real assets are created equal. The most effective inflation hedges benefit directly from rising prices and can pass through cost increases to customers. This requires careful selection based on business models, competitive positioning, and pricing power. Utilities represent one of the best inflation hedges available. Electric utilities own power plants worth billions and have regulated revenue streams that adjust automatically for inflation. Many utilities have rate structures allowing them to pass fuel costs directly to customers, protecting margins during inflationary periods. Companies like NextEra Energy and Southern Company have demonstrated consistent inflation-adjusted returns over decades. Railway companies own vast networks of tracks, terminals, and equipment that appreciate with inflation while generating revenue through transportation services. Railroad companies like Union Pacific and CSX have demonstrated ability to raise prices faster than inflation because they provide essential services with limited competition. Pipeline companies that transport oil, natural gas, and petroleum products own infrastructure assets worth hundreds of billions. Companies like Enbridge and Kinder Morgan have contracts that adjust payments based on commodity prices or inflation indices, providing direct inflation protection. Real estate investment trusts provide exposure to commercial real estate without direct ownership complexity, focus on REITs with short-term leases or inflation escalation clauses. Industrial REITs like Prologis own warehouses with leases including annual rent increases tied to inflation. Data center REITs benefit from growing demand and can increase rents as services become more valuable. Energy investments deserve special attention because energy costs drive inflation throughout the economy. Companies like ExxonMobil, Chevron, and ConocoPhillips own oil and gas reserves worth trillions and generate higher revenues when energy prices rise with inflation. Mining companies that produce gold, silver, copper, and other industrial metals benefit from higher commodity prices during inflationary periods. Companies like Newmont and Freeport-McMoRan own mineral reserves that appreciate with inflation while generating income through production. For most investors, the best approach is through diversified funds. The Energy Select Sector SPDR Fund XLE offers diversified energy exposure. The Utility Select Sector SPDR Fund XLU focuses on utilities with inflation-protected characteristics. The VanEck Vectors Gold Miners ETF GDX provides gold mining exposure. At JP Morgan, we recommend allocating 30% to 40% of portfolios to real asset investments during inflationary periods. A balanced allocation might include 10% energy companies, 8% utilities, 7% REITs, 5% mining and metals companies, and 5% infrastructure companies. This real asset foundation provides primary defense against inflation by ensuring that a significant portion of your portfolio benefits directly from rising prices throughout the economy. However, real assets alone are insufficient. They must be combined with steps 2 and 3 to create comprehensive inflation protection. Step 2, implement dynamic income strategies. The second step is building dynamic income strategies that adjust automatically to changing inflation rates while providing steady cash flows that maintain purchasing power over time. Traditional fixed income investments become worthless during inflationary periods, but specific types of income investments actually benefit from rising inflation. At JP Morgan, we've identified several categories that provide inflation protection while generating reinvestable cash flows, Treasury inflation-protected securities, floating rate debt instruments, international bonds, dividend growth stocks, and inflation-linked real estate income. Treasury inflation-protected securities, or TIPS, are government bonds that adjust their principal value based on changes in the consumer price index. When inflation rises, the principal value of TIPS increases proportionally, ensuring purchasing power preservation. TIPS also pay interest based on adjusted principal, meaning both principal and interest payments increase with inflation. At JP Morgan, we recommend allocating 15% to 20% of portfolios to TIPS during inflationary periods. The most effective approach is building a TIPS ladder with bonds maturing at different times through funds like the iShares TIPS Bond ETF. Floating rate debt instruments provide another source of inflation-protected income. These bonds or loans have interest rates that adjust periodically based on current market rates. When inflation rises and interest rates increase, floating rate securities automatically provide higher income. Bank loans are floating rate debt instruments that adjust quarterly based on short-term interest rates. The Invesco Senior Loan ETF provides diversified exposure to bank loans. The iShares Floating Rate Bond ETF offers exposure to floating rate corporate debt. International bonds provide protection through currency diversification and exposure to different interest rate environments. Emerging market bonds deserve particular attention because emerging market countries often have higher interest rates and currencies that may appreciate relative to the dollar. Dividend growth stocks represent one of the most powerful tools for fighting inflation over long periods. These are companies that not only pay dividends, but consistently increase their dividend payments over time. The best dividend growth companies can increase dividends faster than inflation, providing real income growth. Focus on companies that have increased dividends for at least 10 years with business models supporting continued growth during inflationary periods. The Vanguard Dividend Appreciation ETF focuses on companies with 10 consecutive years of dividend increases. The ProShares S&P 500 Dividend Aristocrats ETF invests in companies with at least 25 consecutive years of increases. Real estate income trusts that focus on properties with short-term leases or inflation escalation clauses provide another source of inflation-protected income. Industrial REITs often have leases with annual rent increases tied to inflation. Data center REITs can increase rents as their services become more valuable. The allocation to dynamic income investments should represent 25% to 35% of portfolios during inflationary periods. This might include 15% in TIPS, 10% in floating rate securities, 5% in international bonds, and 5% in dividend growth stocks or income-focused REITs. Step 3, global diversification and currency protection. The third step is implementing global diversification strategies that protect against domestic currency debasement while capturing inflation-fighting opportunities in international markets. Inflation often affects different countries at different times, creating opportunities for investors who understand how to access global markets strategically. At JP Morgan, we've observed that inflation is rarely a purely domestic phenomenon. It reflects broader economic forces that affect countries differently based on their monetary policies, fiscal positions, economic structures, and natural resource endowments. Currency diversification is critical because inflation often weakens the domestic currency relative to currencies of countries with lower inflation or stronger economic fundamentals. International investments provide natural currency hedging that can protect purchasing power when domestic inflation rises. International stocks offer exposure to companies that may benefit from different inflationary dynamics than domestic companies. European companies that sell globally may benefit from dollar weakness during U.S. inflation periods. Emerging market companies that produce commodities may benefit directly from higher commodity prices that drive inflation in developed markets. Developed international markets like Europe and Japan offer exposure to companies with global operations and different business models than U.S. companies. Swiss companies deserve particular attention because Switzerland has a long history of monetary stability. Swiss multinationals like Nestle, Roche, and ABB operate globally while being based in a strong currency country. Emerging markets provide exposure to economies that may benefit from commodity price increases that accompany inflation in developed markets. Countries like Brazil, Russia, and South Africa are major commodity producers that benefit when inflation drives higher commodity prices. Commodity-producing countries like Canada, Australia, and Norway offer exposure to economies that benefit directly from higher commodity prices. These countries have strong fiscal positions in currencies that often appreciate during periods of global inflation. At JP Morgan, we recommend allocating 20% to 30% of portfolios to international investments during inflationary periods. For developed markets, the Vanguard Developed Markets ETF provides broad exposure to European, Japanese, and other developed market stocks. For emerging markets, the Vanguard Emerging Market Stock ETF offers diversified exposure. Currency hedging decisions are important. During periods of domestic inflation that weaken domestic currency, unhedged international investments provide better inflation protection because currency appreciation enhances returns. Gold remains the traditional store of value during currency debasement and extreme inflation. The SPDR Gold Shares ETF provides direct exposure to gold prices. Gold mining stocks offer leveraged exposure to gold prices while providing potential dividend income. Implementation and portfolio construction. Implementing this three-step inflation beating plan requires careful portfolio construction that balances the three components while considering individual circumstances, risk tolerance, and investment time horizon. A typical inflation protection portfolio might allocate 35% to real assets, 30% to dynamic income strategies, and 25% to international diversification, with the remaining 10% in cash and short-term investments for liquidity and rebalancing opportunities. Within the real asset allocation, diversification across energy, utilities, REITs, mining, and infrastructure prevents concentration risk. The dynamic income allocation combines TIPS, floating rate securities, and dividend growth stocks to provide multiple sources of inflation-adjusted income. The international allocation provides currency diversification and access to global inflation-fighting opportunities through both developed and emerging market investments. This geographical spread ensures protection against domestic policy mistakes while capturing global growth. Rebalancing is critical for maintaining effectiveness. At JP Morgan, we recommend quarterly rebalancing for inflation protection portfolios because inflation dynamics can change rapidly and asset prices can diverge significantly from fundamental values during volatile periods. Systematic rebalancing removes emotion from decisions and ensures buying low while selling high. Success requires discipline and patience. Inflation protection isn't about quick profits. It's about preserving and growing purchasing power over decades. The strategies that worked during previous inflationary periods still work today because they're based on fundamental economic principles rather than temporary market conditions. The choice is yours. Accept the gradual erosion of wealth through inflation or take action to protect and grow your purchasing power through systematic application of these time-tested principles that have enabled smart investors to thrive during every inflationary period in modern history.